Most investors focus almost entirely on which investments to own, which fund, which manager, which stock. But there are actually four investment decisions that shape long term outcomes, and most investors have only ever thought carefully about one of them. Here are the four. Decision 1: Asset allocation. The mix of stocks, bonds, and cash. This is what determines the fundamental risk and return profile of your portfolio, how it behaves across different market environments over time. It receives the least ongoing attention of all four decisions, often set once and rarely revisited. Decision 2: Asset location. Not what you own, but where you hold what you own. The same bond fund in a traditional IRA versus a Roth IRA versus a taxable brokerage account produces different after-tax outcomes, sometimes substantially different over a long retirement. This is the decision almost never discussed. Decision 3: Security selection. Which specific fund, stock, or bond you choose within each asset class. This can add or subtract modestly relative to simply owning this asset class broadly. Decision 4: Market timing. When to buy and sell. It is where most investor attention and most financial media focus. Consistently difficult to execute well. Evidence suggests that attempts to time the market often reduce rather than add return over time, and yet it drives most investment anxiety. The mismatch in that list should be visible. The two decisions that receive the most attention, selection and timing, are the ones with the smallest measurable impact. The two that receive the least, allocation and location, are the ones that shape the structural character of the portfolio and its after-tax efficiency over decades. Let me give you a simple framework for asset location. Bonds and fixed income generally, but not always, belong in tax-deferred accounts, traditional IRAs and 401ks, because the interest income they generate is taxed as ordinary income, and sheltering it defers that tax drag year after year. High growth equities generally belong in a Roth, where long-term compounding happens entirely tax-free. Tax-efficient indexed ETFs generally belong in taxable brokerage accounts, where low turnover minimizes annual capital gains distribution, and the step up in basis at death benefits your heirs. Vanguard's research has estimated that thoughtful asset location can add somewhere in the range of 0 to 75 basis points in annual after-tax return, depending on the investor situation and account mix. This is an illustrative range, not a guarantee, but it illustrates why asset location deserves to be in the same conversation as asset allocation. Your allocation is the architecture. Asset location is the tax efficiency built into that architecture. Both decisions are made at the portfolio level before any individual investment is selected. Two questions worth sitting with after this video. First, do you know your current asset allocation? Not approximately, specifically. And second, do you know whether your bonds, equities, and cash are held in the most tax-efficient accounts for each? Most people can answer the first, fewer have a clear answer to the second. Drop where you are in the comments.